This is a live show where James Boyle and myself, Richard Taylor, get together with our fellow professionals in the expat space, someone who has something of value or interest to share with our community of British expatriates living in America, and we get them to tell us their story and spill the beans. With James and I today is Simon Misiewicz for our regular monthly installment of our live Q&A with a US-UK cross-border tax advisor, which is Simon, and financial planner, which is me, and James, of course. I'll allow Simon to introduce himself shortly, but Simon's a founder and managing director of Optimize Accountants in the UK, who have been providing property and expat tax advice for 20 years, and who we at Plan First Wealth have recently entered into a strategic relationship with, of which I will share some more details in a second. Before we get into the good stuff, I just need to ask James to read a short disclaimer. So, James, take it away.
Of course. Plan First Wealth is a registered investment advisor. The information presented today is for educational purposes only. Plan First Wealth does not provide any tax and/or legal advice and strongly recommends that clients seek their own advice in these areas, which makes our current guest the perfect partner here. I do want to note, too, if anyone's watching live, feel free to send in questions or comments as we go. We do have a couple questions we've been wrestling with, we'll touch on, but certainly feel free to send them in as we go here. Richard, back to you.
Simon, do you want to just quickly tell everyone who you are?
Yes, of course. So Simon Misiewicz from Optimize Accountants, as we already discussed. I focus very much on the US and UK tax, so cross-border taxation. For people that are looking to move from one country to another, so it's ideal for what Plan First Wealth are doing, or anyone that is looking to set up a business or invest in real estate property.
Superb. All right. Should we tell everyone about what we've just launched? So everyone who isn't on our email list, which sort that out, go to planfirstwealth.com and join Wealth Hub, and you'll get emails from us each week on a Friday when we post a podcast or have some news to share. But our email last week announced the release into the wild of our new tax pillar. We call it a pillar service offering to our clients, where we have joined forces with Optimize, with Simon and his team, to provide tax preparation and planning to our clients. We're very excited about this. This has long been something we've been wrestling with. We have our clients and ourselves, we've struggled with tax advisors in the US for a long time. There's a dearth of knowledge and experience for cross-border matters, particularly UK specific. And that can get people into a real pickle. And there are some great firms in the UK doing this, but they can be extremely expensive, prohibitively so expensive. And we also wanted to work with someone who was not just backward looking, which is what a lot of tax preparation is. It's like reporting what's already been done. We wanted to bring something in that was forward looking, proactive, to help minimize tax obligations, not avoid or evade or anything like that, but just strategically, responsibly, forward looking tax management, tax preparation, tax planning to reduce, mitigate, and be compliant. So we're really excited to announce our relationship, formally announce our relationship with Simon and Optimize, and bring that to Plan First Wealth clients.
Just a quick note actually on that. So avoidance is legal, evasion is not.
Yeah. Important distinction, right? Very important distinction. But so legally tax avoid, never tax evade. Correct. Okay, so if there are any British expatriates out there, look, if you're not a client of ours, it's our standing advice. You should work with a cross-border tax advisor. There are some out there. We would urge you to reach out to Simon, regardless of whether you work with us. But if you work with us and you're looking for coordinated, coherent, compliant tax preparation alongside forward-looking tax planning, we've got you covered. So let us know. Okay, right. What are we going to do today?
So this tags on a conversation we had last month, which generated a lot of questions in and of itself. Probably a good place to start. and that is what we call PCLS, somewhat casually, also known as pension commencement lump sum, or if you're from the UK, you may just know it as the 25% of your pension that you can withdraw in the UK that is tax-free in the UK. So our conversation centered around its taxation in the US.
So, Simon, where we've been going back and forth on this for a while now. Where are you at? What's your thinking?
So, from last month's episode, I and the other tax advisors around the table sat down and went through the tax treaty in different aspects. And I don't know if anyone listens to understand de bono. There's 7 hats of thinking, but there's a hat for negative thinking. There's a hat for positive thinking, and it's about utilizing those hats. So we all took turns of wearing a cynical hat of where things could be taxed, and then another hat of being positive about the whole thing. We all went round in circles, and then we sent out an email to each other to say, is PCLS taxable or not? And there's something that you raised in the last session, Richard, about the Article 17.1b, which is the UK-US tax treaty, which is centered very much around is it part of the savings clause, or is it lump sum, therefore not taxable? Because in the United Kingdom, the lump sum is not taxable. And part of the problem is how the US define lump sums. So they have a different aspect of it. So the HMRC manuals and IRS manuals differ in terms of lump sums and how they treat them. And that's part of the issue that I had last month. And that's when I went back to the team to say, this is my argument of sitting on the fence, of not really committing either way.
So, Simon, can I just jump in? So, to rewind a second. So, there's an IRS letter, right? That's from 2008, which says it talks about PCLS, and it says under 17.2. This is critical, and it sounds very specific, but it really is. Under 17.2 of the treaty, lump sums are subject to the savings clause, and it's therefore taxable. But then there's this whole other school of thought that tax advisors say that's great, but it's not 17.2 that applies.
Correct, yeah.
Because it's not a lump sum. Therefore, it's 17.1b that applies. Oh, and the savings clause doesn't apply to 17.1b. Therefore, it's not taxable.
Yeah.
And then you're like, wait, so right, that's good. So 17.2, which causes lump sums to be taxable in the US, but it's not a lump sum. But wait, it's literally called pension commencement lump sum. So how is it not a lump sum? And you're like, well, then you get to your point, and you get really technical on what the US defines as a lump sum, which is an entire distribution, right? And it's not an entire distribution, therefore it's not a lump sum. And so it's like there's some not torturous is the wrong word, but it's kind of.
Well, and I think that's part of the problem that I purposefully challenge not the tax treaty as such, but I look at the HMRC manuals, look at the IRS manuals, and try and find synergy of language and terms. And this is the whole lump sum. Back to your point, actually, the IRS is all about the entirety of your savings account versus the HMRC's, which is, well, it's part of the distribution. So then my guys challenged the whole thing to say, well, we should still stick to the tax treaty because that's why it was written. 17.1 was, in a sense, was saying whatever is taxable in one country will inevitably be discounted, so it won't be taxed in another country, and the treatment of certain investments should be the same in both countries. So this is where I got into a detailed conversation with my guys to say, where do we sit? And not going to read verbatim what the end, and I've shared this with you already, Richard, but the idea behind it is that they can stand by 17.1b of the US-UK tax treaty, leveraging the reciprocal pension exemption clause to assert that the 25% distribution of the UK pension remains tax exempt. According to the clause mentioned above, any pension from a pension scheme established in the UK should be free from taxation in the US, provided it is exempt from tax in the UK, which it clearly is. And that is the point of where we got to say, well, actually, we should ignore what the IRS manual should say on that entire thing, because the reason why a tax treaty is put in place is because of this, is there are nuances that will come into play, and albeit the IRS have not in any of their manuals got anything to do with the PCLS, and why should they? So I think coming back to it, is it taxable? We would stand by it to say it's not taxable, but there's always going to be this issue at some point in the future whereby the IRS could then raise their head and say, well, we're challenging that notion. So one of the things that we've got as a disclaimer for anyone that uses the PCLS treatment as non-taxable is that it's up to them to take the risk if the IRS come back and say, well, we think it's now taxable. We'll defend it using 17(1)(b), of course, but the IRS have the right in many ways to view a position and then put their opinion forward. Whether it's right or wrong, you would then go back into this whole court proceedings and appeals and so on. Now, to substantiate the point of 17(1)(b), it is obviously a UK-US tax treaty. We would use the form, the 8833, which suggests, hey, I'm submitting my 1040 tax return. There is a tax treaty. I'm going to fill in form 8833, which basically says this is the tax treaty I'm relying upon so that my PCLS is non-taxable. And I think that's where we got to in the end.
That's super interesting. You've been on quite a journey with this one. I think it's totally, reasonable to explain that to someone and have them make a call. And if they want to be ultra conservative, pay tax in it. If they agree that 17(1)(b) applies, then make the case, but know it could get challenged. And ultimately, people need to understand that this stuff will only get settled in court. The IRS wrote that letter in 2008. That's their position, but that's not a statement of law. It's a statement of their opinion, and it doesn't even answer the question of 17(1)(b). So ultimately, someone will take it to court. If it got challenged, would have to take it to court and have a precedence established there, and then that can be overruled by a higher court. It's
the one thing I would say is, what anyone that wants to put this forward, you can use this kind of disclosures to the IRS as part of your tax return to say, this is what we've done. We haven't calculated any taxation on it. Give me your views. And you're offering up to the IRS their opportunity to review that particular issue. So we have already identified one client that we're going to do this with, and they've said themselves that they're quite happy to put it through. It's their risk, and they're also happy for us to put this disclosure in to front it up. So if they are within 2 years, don't do anything with it, that's case closed.
Is that the statute for 8833, the 2 years?
Yeah.
Right, so let's segue this then into 8833. So anyone who doesn't know, 8833 is when you take a position based on a treaty. So in this case, you're taking a position that the PCLS is not tax-free. That's based on interpretation of the treaty. When you take a treaty position, oftentimes you're supposed to proactively disclose that on Form 8833. So you can tell the IRS have done it, and they can go, okay, we agree with that. We don't agree with that. We're going to challenge it. And if you don't make a treaty-based disclosure on 8833, you can have statute of limitations issues and other such problems. I don't even know does it invalidate if you don't actively make a claim? Does that mean you're not invoking the treaty? I don't know, but so Simon, there's multiple. So PCLS is just one example of when you're utilizing the treaty. So the rollover from a UK pension into a SIP, say you're utilizing the treaty. The transfer would be exempt when on an annual basis when you defer gains on funds that you buy and sell, when you defer tax on dividends and income received, that's taking a treaty-based position, PCLS. So, but then I also know there is a exemption in the code for pensions. So, when should people with a SIP, when should they be filing 8833?
So, and again, this is sort of as a team we pulled this together, and it's something that is bullet point fashion, which I'll just read because it's very sensible in terms of its approach. We all agree that it is better to fill in this 8833 whenever these circumstances arises. And the first point is when seeking treaty benefits that modify the taxation of a specific income type, such as income derived from dependents, personal services, pensions, annuities, social security, public pensions, or income earned by artists, athletes, students, or trainees or teachers. So it's really looking at, well, if the income is earned in another country, UK disregard, and there is a specific treaty about how that should be treated in one country versus the other, then you should use it for that point. The second point was when receiving payments or income items amounting to more than 100,000 exempted from taxation by a treaty as mandated by the IRS. So again, PCLS could be a good example of that.
Mm-hmm.
And third point is when asserting a reduction or modification in income taxation not addressed within the categories as mentioned earlier, leading to a tax reduction exceeding 500. So anyone listening in and thinking, oh, crikey, what does this really mean? And what should I actually use it? I would always take the position of, well, if you're doing a 1040 tax return and you're mentioning anything to do with UK or any other foreign investments, income, or any other that type, it's safer to go with the 8833 than not. And it doesn't take too long to fill that form in anyway. So even though my guys keep saying, well, actually, you don't need to because it's not, it's not part of that. I always take the position of, well, it's a 5-minute form. Why not put it in?
Simon, right? So how do you make head or tail of this? So I'm looking at what you just said, what you said then, and the first bullet point talks about when seeking treaty benefits and modified taxation, blah blah blah, and then ... pensions, right? So it's specifically saying you need to complete 8833 when pensions are involved, right? But then going to after your bullet points, you list the exception. There are exceptions, and it's unnecessary for positions on income from blah blah ... pensions. So why did the IRS say
that's below 10,000 though? So when the first point was talking about any amounts, but the exemption is where it's less than 10,000. But again, my view is, all right, my tax. we are allowed to disagree on these points. I still that's the law in terms of what you should not do. But when it comes to 8833, I think it's better to identify all of your assets, to identify all your income streams, and then just put that 8833 in there to settle the argument, just in case it comes up at any point. Again, are there any issues by you putting it in? No.
So would you do an 8833 even just every year someone's got a SIP for the deferral of if they sold a fund within the SIP, but you would do it for that?
And exactly, because you may have legacy issues. You may have things that are active but not present in the tax return. And that back to your point of funds may be invested, funds may be exchanged. You want to really define that, if the IRS investigate and say, well, you didn't use that tax treaty that year, so can we now tax you on those funds that you haven't reported? That'd be quite harsh. So therefore, I just think for my sanity, I would rather people put that form in to just avoid any noise of the future. And I'm always about that. It's about putting in a tax return that you feel confident, not just about today, but you're confident about any inquiries that may come up in the future. So
I'm thinking of this from a SIP perspective. So someone rolls over their pensions into a SIP, they 8833 for the roll, and then 8833 every year when you've got gains and dividends, presumably within the SIP, deferring them, and then 8833 when you take money out, when you take PCLS out, and What
a safety
about
net, if anything.
what about pre-SIP? What about someone's, I'm thinking of a client right now, 4 or 5 UK pensions, Aviva, Scottish Widows, Master Trusts. Should they be doing that?
I mean, the one thing about the tax treaty, and I'm going to use an angle of Hong Kong that has no tax treaty with the US, whereby if you have a fund in the Hong Kong and it generates an income, or your employer, and this is classic, if you have an employer that contributes towards your pension in Hong Kong, that will be taxable in the US because there's no tax treaty. So my point of any money going into your pension, any money coming out or be moved around in your pension, it is always better to say, hey, we've got a tax treaty. So this tax treaty says you should not tax me on the movements of pension, my employer contributions going into that pension. Don't tax it. That's especially when you've got salary sacrifice, when it's not always obvious what's going on from a UK tax perspective, but the IRS then starts saying, well, what's your contract say? And then try and penalize you for it. And that's why I say the tax treaty between the UK and US should be reported. It should be notified to the IRS, just again, as a safety net to say, hey, these are the agreements that are in place. If my employer is contributing to a pension, or if I am contributing to a pension, I'm getting tax benefits of some type, and it should be reciprocated in the US.
Got it. Okay, right. Talking about belts and braces. So we're saying 8833 should be done. This is going to be way over most people's heads, but 8621. For those who don't know it, Form 8621 refers to PFICs. PFICs are non-US investment funds. So mutual funds, unit trusts, ETFs that are not in the US. So if you've got British or European investment funds, they're PFICs. They can be taxed incredibly ugly if they're outside a pension, but they also require a form called 8621. There's no penalty for not filing 8621, but it can keep statute limitations open. So, and there's some debate in the community between whether 8621. So many SIPs, many UK pensions will hold PFICs because for many reasons, and oftentimes it's believed that the wrapper, the IRS stop at the pension wrapper. They look at the SIP. So as long as you're reporting the SIP, you're okay because there's no tax consequences. But some people think 8621 is required for the PFICs in the SIP, even if there's no tax due. So what's your position, Simon?
And again, I apologize to anyone listening in here, watching, but I am going to read what we eventually beat ourselves into a submission over between the tax advisors. So here we go. Many foreign grantor trusts are not protected by the US-UK tax treaty, but the good news is that a SIP does qualify. SIPs it's considered a qualified pension in the US-UK tax treaty, and as such, its earnings are exempt from US tax until such time that the money is withdrawn, which is the normal pension. Where this becomes particularly useful is when the SIP holds investments in foreign mutual funds, such as ETFs or index funds. In these circumstances, you can avoid having to report an individual passive income company PFIC within the SIP, which can be time-consuming and very expensive. So if you're a keen investor, then a SIP can often be a much better way for you to invest and save a lot of time and money from your filing. Just one last thing here, that per the instruction for Form 8621, a distinct form must be submitted for each passive foreign investment company. So if you've got many firms, mutual funds, you have to do them on these Form 8621 for each and every single one. Wherein the shareholder holds back, whether directly or indirectly, if a shareholder possesses one PFIC and through it has ownership in one or more additional PFICs, a 8621 form is required for each one in the chain. That is huge. Now, just to finish off, by the way, because obviously we talk about pensions, but anyone that holds a UK limited company that also holds passive investment assets, such as real estate property, which is interesting because you had that call last week. For Americans investing in other countries whereby they have a company in that jurisdiction and then they buy a real estate property, there is a huge danger that that is also considered to be a PFIC and has to be put on an 8621 in addition to a 5471 form.
Yeah, I'm just thinking about a client actually who's got a building in a limited company.
Yeah. Now, the way around it, though, anyone listening in, if your business is trade and activity, so if it's a property development company, that's fine. If it's I've got a rental property and I'm collecting rental income, but I'm not active in that business, which we have very similar UK tax rules around that as well, to be fair, then, if you don't pay anyone wages and you're just using a letting agent and you're quite standoffish, then that will fall straight away into this PFIC rule.
What would the answer be? Own it through a US LLC or something rather than a UK limited company?
The problem is with it is I would always say that wherever you have the asset, you should have the holding, you should have a company own it.
Yeah.
For many safety reasons, for legal aspects. I'd never liked the idea of having a UK company that holds directly a US property, because if you get sued, then your company could be exposed entirely. So it's always better if you're in a American company. It's always better to have an LLC. If you're in a UK investment, then it's still better to use a limited company. But you just will the IRS ever come back on you for that, for not filling 8621 forms? It's very suspect. And I think you could always argue, well, I'm a director, therefore I am active in this business. Because it's not as though you're investing money and then there's another management company managing that portfolio for you. It's generally your property. You're managing the letting agent, which is an argument we have in the UK. So, but I think people just need to be aware that PFIC isn't just mutual funds, pensions, and that type of investment.
So you said people owning you just let me ask that question again though.
Yep.
What about owning UK property through a US LLC?
I would advise against it.
Again, you would advise against it? Yeah,
and there's a couple of reasons for that. And this has happened to someone who's actually based in Dubai. So they had purchased a UK property in Dubai, and HMRC said, well, that's interesting. Because of the presence of the investment, we want to tax you in the UK. So they had to do their own tax returns in Dubai, but then they had to do another supplementary tax return in the UK and pay taxes to HMRC. So it could double up, if not triple up, your accounting fees, because you're now having to do this cycle of, well, how does this interact between companies? So it's never a good idea, from to be honest with you.
Okay, interesting. Yeah, you don't want your property portfolio to become a PFIC. All right, something to be aware of. But from our position, so if someone's got a SIP, 3 or 4 UK PFICs in there, you are going to recommend 8621 for each one, even though there's no tax due, just for belts and braces.
Belts and braces, but as I mentioned, as SIPs are, and again, just coming back to what I was reading, that the SIPs that holds these type of investments is fine. It's not going to be in that same regard.
Yeah.
It's any other type of pension that is not that SIP.
Got it. Okay. All right, that was pretty technical. I wonder if there are a lot of forms around, but this is all important stuff, and people are just blissfully unaware of it. Totally blissfully unaware of it. And then sometimes get quite angry when you start bringing this stuff up. It's like, I did not make these rules. I would not make these rules. I tell you right now, I would not make up these rules. But yeah,
it's often the messenger that does get shot, though.
Yeah. Yes. Do you have anything else to cover today, James? Anything else on the docket?
No, I think that covered. We hit every form we had discussed at the top here. Okay. I don't mean to repeat the point, but anyone watching, if your head swims like mine does at the mention of 8621 and 8833 and PCLS, and consult a qualified cross-border tax advisor. Ideally, obviously, that's with Simon. With us, we're biased and we think we can certainly add value and do a good job. But you need to be taking advice for these positions that you're taking. There is an element of protecting yourself, as Simon mentioned, closing the door as much as possible to future mishap that I think people are just not aware of.
I'm in a couple of Facebook groups for Brits, and there's a lot of tax advice being doled out in these Facebook groups, and it really disturbs me because, that does not protect you. You get it wrong.
Advice, is it? Let's be fair.
Yeah, you get it wrong. You can't say, "Oh, so and so in Facebook told me." I think that's not how that will not get you off the hook.
No. Richard, if I may, part of our collaboration effort was to have joined up meetings. I think it'd be quite useful to inform those that are watching what those joined up meetings was about, especially when you talk about tax advisors normally are retrospectively and backward looking. And
no criticism of them, right? That's the job. That's what they're paid to do, right? They're paid to complete a tax return, but we think there's an opportunity for more.
But I'm just wondering if you want to elaborate on that point, because I'm not sure, in terms of whether people understand why we're getting together, what these joint meetings might be about. And I think there's a lot that can be shared here, just to give someone that, okay, this is worth investing time and money.
So, some of the problems we wanted to solve. One was like service, like a good responsive service. Well, another was cost, for a reasonable cost. And then the third point was we're still surprised by the amount of clients we see not in offshore compliance, and by that I mean not filling out some of the forms that I just mentioned, despite us banging the drum about it for years. Some people just weren't hearing it, so I've been really surprised by the amount of people not. So we wanted to offer up a service where we have a direct and ongoing and close relationship with an advisory firm like Simon's, so we can be a second one. We know this tax advisor knows about these things, and second of all, we can be another pair of eyes making sure they're there. Right. So that's this is all backwards looking in compliance. But then the final the piece de resistance, if you like, is the forward looking part, which is where for certain clients within this proposition, we plan on holding an additional meeting with Simon and with the client. The client probably doesn't have to be there if they don't want to be, but I think and expect most will be. And the three of us will get together, and between the three of us, we're going to have a fantastic understanding of the client's position and the client's future position. Our job is all about looking forward, so we're going to know what this client's thinking of doing, when, where, and how, and we can liaise with Simon on, right, this is what's coming up. What are the opportunities? Rather than coming to you in a year's time saying I did this, what about telling you we're going to do this? Is there anything you can do to help us legally, ethically minimize our tax obligations? And that's the piece that I think is missing from everywhere. And that we're looking to bring to our clients for a reasonable fee on top of a great service and cross-border expertise.
I think that's what made me very excited about this collaboration, because it is that forward-looking aspect of investing wealth, growing wealth, whilst minimizing tax and being compliant.
The Holy Trinity. With good service, with good responsive service thrown into boot. That's a hygiene factor, but it's missing from so many places. So there you go. That's what we're doing. That's on offer. Come get it. Right. Anyone got anything else to add?
Oh, there we go. We've got a question in, haven't we?
Yep. Good timing from a comment here. So a commenter has posted a question. I'm a property BTL investor in the UK, considering to put my pension contributions into a SIP, into a gold investment. Would you say it is safe to do so? Bit broad. We may have to interpret that a bit.
Can I talk about the tax side of things, then maybe you come in with the investment?
Sure, please.
So from when everyone has got a buy-to-let investor in the UK, I'm putting my pension contribution into a SIP. Depending on how you hold this investment, if it's held in your name, the amount of pension contributions you can make has gone up to 60,000, or certainly it will be. But if you own property buy-to-let portfolio and you only invest in that, so that's the only income you have, your net relevant earnings is maxed out at 3,600, irrespective of how much profits you make. So if you don't have any other form of income, then the maximum pension contributions you can make will be 3,600. If you own that inside of a limited company, you're back to the maximum amount of 60,000. So it can really help you reduce taxation and invest in pensions using limited companies. And that's why I do think they are good tax structure for most investors.
Okay. Do you think by gold investment he means literally like buying a gold fund or something?
That's my reading of it.
Not like a gold standard invest. So I would just say we're not big believers in gold. Answer your question, would it be safe? I mean, yeah, as long as it's not, it's not a fraudulent fund, but gold is a safe investment. Whether is it a good investment? I don't think so. And the gold's not producing anything. It's a store of value. There's no income derived from it. It's not producing anything. It's not working itself to generate more gold. And if you look at the history of gold, it's not historically been it's not even been a particularly good store, a hedge against inflation recently. So safe, yeah, if you don't mind losing money against inflation, but a good investment. What's it going to do for you over 20, 30 years? I would say, I would argue not. I don't have a crystal ball, but I would argue not.
Yeah, Richard, just to tag on there, I would challenge this investor to think about the goal for the account, right? So a pension generally is going to be designed to keep up with a rising cost of living over 20, 30, 40 years. And I would consider what kind of strategy is going to produce returns over that long of a time horizon, if that's the goal for the account.
Tax efficient. So I don't know is the honest answer. I mean, it'll
be got to be tax efficient, isn't it?
Yeah.
Because you're not taxed on income generated from assets. You're not capital gains tax. You're not going to be suffering from inheritance tax, provided the 75-year-old approach is adhered to. Then it's free from inheritance tax as well.
But again, so what you're in a pension, you're looking to defer tax on income and growth. Well, I don't think you'll get much income or growth from a gold investment. So, yes, it could be if there was income and gold, but I don't think it would be tax efficient.
Agreed.
Excellent. Well, I want to thank everyone for listening and watching. Certainly, if you have questions on the offering, the joined up partnership between Optimizer Accountants and Plan First Wealth, reach out to either one of us. Simon, what's the best place for anyone to find you?
I would always go to our website in the first instance, where we have a lots of information, free tax calculators for US, UK, which is www.optimizeaccountants.co.uk.
Excellent. And likewise, on our side, we mentioned our newsletter that comes out weekly. I think I'm safe to preview we have a lot of announcements coming up through the fall. So certainly make sure you jump on our website, planfirstwealth.com, sign up for the newsletter. And importantly, if you're not watching this on our Facebook group, we would encourage you to join that as well. That's Wealth Hub US UK. So again, if you go to Facebook, search for Wealth Hub US UK, join us there.
Just 1 second. Just with the person's asked, according to them, it's higher than property and property has maintenance costs. Just want to finish with one thing. I don't know this person. I don't really know what's going on here, but it sounds to me like someone is selling this person gold as an investment. Just I don't know. I don't know enough to make this, but if you're being sold gold in a pension, just step back from this, whatever it is, and just take a minute, speak to someone else. Because there's a couple of warning bells going off from these comments that I think someone might be leading you somewhere. I could be completely wrong, but just step away from this for a second and maybe speak to someone else.
I think that's a fair reading, Richard. I think that last comment that sounds like maybe what's happening.
Yeah.
Perfect. So again, you can reach us at our website, planfirstwealth.com, and the Facebook group. Happy to chat and talk about our new offering. Thanks everyone for joining.
Thank you. See you soon. Thanks, Simon.